Welcome to this deep dive. Today, we are looking at a massive stack of sources, specifically a comprehensive 2026 strategic and financial analysis of Coinbase.
Right. And the mission here is to uncover how, what started as a simple crypto onboarding app systematically evolved into a foundational pillar of the global financial system.
Okay, let's unpack this. You know how finding an old flip phone in a drawer is a shock because it literally only made phone calls?
Yeah, it's like a total relic.
Exactly. And most people still think of this company as that basic flip phone, just a place to simply buy Bitcoin.
But it has quietly morphed into the everything exchange.
Right, a completely different beast.
The physical form factor, like the app icon on your screen, it looks similar, but the underlying utility is a total evolution. I mean, the 2021 era platform was highly dependent on cyclical crypto trading.
Which was incredibly volatile.
Oh, absolutely. Now, they aren't just offering new features, they're providing the base operating system for traditional finance.
Sort of like a smartphone ecosystem.
Spot on. Much like a smartphone is an entirely new ecosystem where third parties build utilities. They have integrated U.S. equities directly via NASDAQ.
Oh.
And derivatives from their $2.9 billion acquisition of Deribit, and even real-world prediction markets.
So they're acting as the unified rails for the entire system now.
Yeah, and what's fascinating here is how this operating system approach strategically decoupled them from the notorious volatility of the crypto price cycle.
Because the cycle is brutal.
It is, but by 2025, they brought in $7.2 billion in revenue, and 20% of that came purely from stablecoin yields alone.
Wait, 20%. So they're essentially monetizing passive digital dollars.
Yeah, exactly.
Instead of relying on transaction fees when market is hot, they capture traditional fixed income yields on digital dollars, just, sitting idle on their platform.
It fundamentally changes their business model into a highly resilient operational hedge. When trading volume drops, that steady yield acts as a massive financial anchor.
Right. So to truly capture your entire financial life cycle, this digital wealth has to eventually interact with the physical world.
Specifically, the largest real-world asset class, which is housing.
Right, housing. And they recently launched a partnership with Fannie Mae and Better Mortgage.
But wait, I have to push back on the mechanics here. Wait, so you use Bitcoin as collateral for the down payment, but you don't actually have to sell it?
Correct. You hold on to it.
But what happens when crypto has one of its infamous 40% weekend crashes?
Which, it definitely does.
Right. Doesn't the homeowner instantly get liquidated and lose the house?
Well, if we connect this to the bigger picture, the architecture of the deal prevents that. It is a highly sophisticated dual loan structure.
Okay, how does that work exactly?
So you pledge your digital assets for a privately financed down payment loan equipped with massive over-collateralization buffers while securing a standard Fannie Mae-backed mortgage for the house itself.
Oh, I see. Yeah, historically, buying a house meant liquidating your crypto, which obviously triggered massive capital gains taxes. Keeping the crypto locked securely in institutional custody bypasses the tax hit entirely.
Here's where it gets really interesting, though. If you use a stablecoin like USDC as collateral instead of a volatile asset like Bitcoin, that collateral continues to generate staking yields.
Exactly. And that yield can then be systematically routed to offset your fiat mortgage interest rate.
You effectively have money that pays your mortgage interest for you while serving as the collateral.
It's kind of wild to think about.
It is. But as this platform handles higher stakes, real-world assets like mortgages, the target on their back grows exponentially.
Oh, for sure. Integrating decentralized money into the real world exposes a major friction point, which is centralized human infrastructure.
Right. We saw the result with the catastrophic May 2025 beta breach and its $400 million fallout.
The irony of that breach is striking. I mean, their military-grade AES-256 encryption is mathematically bulletproof. It wasn't hacked at all.
Right? Malicious actors simply bribed customer support to access centralized customer IDs.
Yeah, they bypassed the cryptography entirely through, basic social engineering.
Which brings us to the ultimate friction point, regulatory standoffs.
Definitely.
Just 2 days ago, on April 2, 2026, they secured a monumental victory, an OCC National Trust Charter.
That means they practically have the federal blessing to operate with the exact same trust powers as a legacy bank.
But then we see the total collapse of the Clarity Act legislation over stablecoins.
Which raises an important question about the structural tension between legacy and digital finance. We are watching two entirely different, competing monetary philosophies colliding in real time.
Right, and it's a purely objective standoff.
Exactly. The banking lobbies aggressively view yield-bearing stablecoins as a direct systemic threat. The mechanics are simple. If a user can get a 5% yield just holding USDC on their phone, they will withdraw their savings from their local credit union.
Which, makes sense.
Yeah, that shadow banking dynamic drains local bank deposits, crippling their ability to issue community loans.
But on the other side of that same coin, digital asset proponents view these exact same stablecoins as necessary consumer protection against the debasement of fiat currency.
It's just two completely opposed worldviews fighting over the exact same financial mechanism.
So what does this all mean for you? If you were wondering how this actually changes your life, think about your bank account right now.
The walls between legacy banking and digital ledgers are collapsing.
Completely. Your future stock trades, your daily payments, and even the mortgage on your house are likely going to run on these unified rails.
The everything exchange isn't a theory anymore. It forces us to critically rethink our assumptions about where the actual risks lie in this new system.
Right.
Because the technology is secure, but the legacy touchpoints remain incredibly fragile.
We upgraded the phone, but did we upgrade the SIM card? Because if storing traditional IDs in centralized databases is now the absolute weakest link in financial security, will the next inevitable step be abandoning government-issued paper IDs for fully decentralized cryptographic identities?
That is exactly the question we have to ask.
Definitely something to think about.
Right.